Do we have that sort of triple whammy of
Oh
debt
yeah,
stress, both on the consumer, the corporation side, and the national side,
and the national side too,
or
which
the
is
sovereign side? Yeah.
even bigger. And the T-bond market is, that's the government debt, okay? And you look at that chart and say, this guy has tried to get up out of here so many times in the last 3 years, get a rally going, drop rates, rally the price, and they've all failed. We had a good rally going, for example, back in Jan, Feb, March, April of this year.
Hmm.
Bonds rallied from like 114 to 121 very sharply. Nice rally, and thought, oh boy, we're on our way, right?
Yeah.
Within 2.5 days, it was back down to 111. That's a crash. What happened? I mean, you can't do that with the government debt market. The central bank has to be panicked to the point of wetting themselves without admitting it publicly, of course. They thought, oh, everything's fine. Well, the government debt market is not. And so you now have a problem you didn't have in 2008. Now it's come to the fore. I mean, so many decades of this error compounding and compounding. And even Trump has increased the situation. The debt is increased under his budget. So they may be talking about it, as you said, but nobody's doing anything about it. I think we've got a crisis coming, and it's not just stock market, but it's in the real world. And I think that crisis this time around, unlike 2000 to 2002 or 2007 to 9, is going to create the kind of changes and uncertainty and up in the hands type response by everybody. Like, what the hell's going on type thing, to where we're going to lose, which is fine with me, some institutions that have been around for 100 years. I'm betting you won't have a Federal Reserve, not because Trump doesn't particularly care about it one way or the other, and a lot of Republicans don't, but because it's dysfunctional. And there's a lot of people realizing it's really been a boom bust cycle generator. Not just the Austrian School of Economics, but others are saying, this really thing hasn't worked well. They're always behind the curve, et cetera, et cetera. I also think if you see that pinching effect that you're talking about, or the choking effect of debt, particularly personal debt. Income taxes are in question. Not so much because some Republicans just soon get rid of it anyway, but because it's dysfunctionality in terms of the source of government revenue, which it's become more and more every year in terms of the revenue that it generates, as what was expected is less and less. And there's a point at which people simply say, oh, I have to request a delay, or, oh, I need a plan. I'm driving around town and I'm listening to Sirius radio, whether I turn on CNN or Fox Business News or whichever. There's constantly ads about, we can help you with the IRS.
Hmm.
That's like 50% of the ads. Well, I didn't know there was a problem. Yes, I do. But I mean, that could be the kind of crisis where all of a sudden income taxes are abolished. Not so much because they intellectually like the idea to do it. It's just that it's dysfunctional, and they revert to a national sales tax. Let the shopkeeper collect taxes for the government. All these kind of changes could occur, and I don't think there'll be a surprise. There'll be a surprise for many, but I think this is different this time. I think the world, it's not just the US. I think a lot of countries are going through major change, or about to, especially if we enter the kind of crisis we're talking about with the stock market down. The data points will go with it. Day-to-day life will change, much like it did in 2007 and 8, if you recall.
Hmm.
Argentina is an interesting example. The president of Argentina, elected like a year ago, Javier Milei, is an anarcho-capitalist, and he busted both parties in the election with the youth vote. And a lot of the vote that he got to become elected president was desperation, especially young people just throwing their hands up in the air saying, this stuff hasn't worked for decades. This two parties back and forth, still a socialist state, turned Argentina into a third world country. Used to be the seventh biggest economy in the world, 50, 60 years ago.
Right.
And then he comes in, and what is he doing? He's abolishing stuff. He got rid of rent controls. Suddenly rent prices have collapsed, which makes him happy. But he's throwing away notions that have been around for decades. He's tossing them. And it's sort of an emotional, not on his part, he's an intellectual, but on the public's part to vote for him. It wasn't like they read what he thought and understood it. It's just that they knew, we need to get rid of these two competing parties, which have brought us nothing but ongoing decay. And once you get a market downturn and the personal pain that goes with that, like we've been talking about, personal debt and so forth, you get this sense of desperation where it's hard to predict what the outcome's going to be, but I bet it's not going to be just another boom bust cycle. It's going to be something far more lasting.
The interesting thing is we're already watching this multi-front squeeze play out. It's like a triple whammy. We've got stress on the consumer side with revolving debt levels through the roof. You've got corporate debt that's ballooned into a giant ticking time bomb, and then you have sovereign debt, which is basically a horror movie with no ending credits. And the sovereign side is by far the most dangerous, because when the government bond market starts breaking, that's not just bad news for some rich guys with portfolios. That's the foundation of the entire system. That's the collateral behind the banks, the insurance companies, the pension funds. That's the, quote, risk-free asset. So when that starts looking unstable, the ripple effects are planetary. And yeah, we've seen these attempts for the T-bond market to get off the mat. Look back over the past 3 years. We had multiple rallies where people said, this is it, yields are coming back down, we're going to get a nice calm rally in bonds. And every single one failed. Just this past January, February, March, April, we had a pretty good push. 30-year futures went from about 114 up to 121. That was a sharp pop. You could hear Wall Street breathe a sigh of relief. People thought, okay, maybe the debt market's going to normalize. Maybe rates will ease. And then wham! Within 2.5 days, it crashed back down to 111. That is catastrophic volatility for the Treasury market. That is not supposed to happen in the world's deepest and supposedly safest market. You know, if that kind of thing happened in Nvidia stock, well, fine. It's a tech stock, that's what they do. But in the US government bond market, that should make central bankers panic. I'd argue they probably are panicking behind the scenes, though they'll never admit it publicly. In fact, they'll stand up there with their calm voice and their fancy models and say, we see no systemic risk. That's their job. Keep the public calm. Meanwhile, behind the curtains, they're probably soaked in sweat trying to figure out how to keep this whole debt pyramid from toppling. And you know, it's funny. The kind of debt problem we have today didn't really exist in the same dimension back in 2008. Back then, the problem was largely subprime mortgages and derivatives tied to them. It was huge, sure. But now it's everything. Personal debt, corporate debt, sovereign debt. Even Trump, who talked tough on draining the swamp, just added to the problem. He increased the debt too. So it's bipartisan irresponsibility. They all talk about cutting deficits and then they keep spending. And look, the math just compounds. Each time the cycle continues, the debt's bigger, the rates eventually have to rise to compensate for risk, and the interest cost balloons even more. This is why I keep saying, we're not setting up for just another 2000 to 2002 or 2007 to 2009 style bust. Those were nasty, but they were contained inside specific asset classes. First the dot-coms, then housing. This time it's the entire structure. That means when it breaks everything. Stock markets, bond markets, banking structures, government credibility, even tax systems. And speaking of taxes, look at the weird tension building around income taxes. You can see it in the social undercurrents. I can't drive 5 miles without hearing ads on Sirius XM or seeing digital billboards saying, struggling with the IRS? Call our lawyers. We'll get you out of it. It's literally half the commercials. That's a clue. It tells you how stressed people are. There's this quiet epidemic of tax defaults or negotiated payment plans or people just falling behind. It's not theoretical. It's happening. If that continues, at some point the system may simply buckle under its own administrative weight. Not because a bunch of Republicans hold up signs saying, abolish the IRS, though they might like that, but because functionally it breaks. People can't pay. Compliance collapses. Then what? Maybe we switch to a national sales tax where retailers become the collection agents. That's a major structural change. But history shows countries under financial stress make drastic shifts.
I mean, obviously.
Oh, yeah. No, I'm not sure how deep the market will go. I mean, you could go back and look at history 29 to 32. I mean, it's like an 80% wipeout ultimate. And it began with a crash and then came all the way back up, halfway back up into March of 1930, and then went down slowly for 2 years, but an 80-something% drop. And it took until 1953 to even get back to the nominal price high the Dow saw in 29, not counting the degradation in the money unit. Similar thing happened in 2000, by the way. People think, oh, wow, the stock market made a low in 2002, great. But in 2013, for the S&P to finally take out that high, those highs, the 2007 highs and the 2000 highs, So you had a decade and a half almost where the market was a wasteland, really, in a range. Anyway, I think we're headed into that, and I think there'll be real world consequences. And one thing we said about a year ago is we thought, well, if Trump wins, a couple things are likely to happen, but one of them is likely to be uncopacetic in terms of public response. And I mean, the opposition. Rather than sitting back on their haunches and waiting for the next election cycle, I suspect if we get economic downturn now that is noticeable to the average Joe, something he thought Trump wouldn't bring on, Trump is going to save the economy. Well, if all of a sudden that doesn't happen, then emotions come into play. Sense of uncertainty. And when that happens, and we know people are hurting on their credit card limits and so forth and so on, we know these data points. We know commercial real estate is in a stranglehold right now. In fact, we had the biggest shopping center in the country. I think it was an $800 million default on debt. 2-3 months ago. Wasn't a headline, but it happened. That you can get uncopacetic things in the street as well.
And by copacetic, you essentially mean civil unrest, correct?
Yeah. In fact, there have been polls done by University of Virginia Department of Politics about 2 years ago. It was. They polled both likely Biden voters and likely Trump voters. If the other side wins, is violence justified? And it was an incredibly high percent, like 20-something% on both sides. And yes. If the other side wins, is that the end of democracy? It was like a 40% odds on both sides. Yeah. In other words, this wasn't a normal election. We're at a point now, if you throw into the mix economic pain and suddenly a sense of disbelief, like, well, we thought, Trump got labor vote, he got a low-income vote who thought this guy can probably solve our problem. He's sort of down to earth. And if all of a sudden that turns out not to be the case, not so much because of what he does or didn't do, it's what has already happened. He just stepped into it. If that unfolds, as we argue it's likely to, then a sense of emotional disbelief occurs. And that's when you get that uncopacetic, unpredicted outcome where all the norms aren't there anymore. And so that's another element that I think is probably we're going to see it this year, especially if we're correct on the stock market, relapsing from a new high, like it did, by the way, in 2007. You made a peak in May. Where was it? Back at the same price as the 2000 bull market peak, 1550 on the S&P. You dropped from May to August, a hard drop, just like we had January through April. Bernanke during that time denied that there's any problem with the mortgage markets. It's totally controllable, he said.
The subprime is contained, yep.
Yes, right. You remember that.
So let's push this even further, because I think where we're heading isn't just about technical charts or ratios. It's about a fundamental crisis of trust. And trust is everything in a credit system. We've basically been living in the biggest credit experiment in human history for the last 100 years. And especially since 1971. We pretend that these pieces of paper or digital ledger entries are money, even though they're just promises, and the whole thing works because everybody agrees to keep playing. But once people start to question that, once confidence gets rattled, the moves that follow are not measured in percentages. They're measured in entire shifts of civilization. It's worth stepping back for a second and thinking about what we're actually witnessing. You've got 3 massive debt fronts all peaking at once. Consumer debt is at record levels, not just in absolute dollars, but relative to disposable income. The average American household is so squeezed that more than half of them can't cover a $1,000 emergency with savings. Corporate debt? Same story. Companies levered up because money was free for so long, buying back their own shares to inflate prices and enrich management. Now, as rates normalize, or even hint at normalizing, those balance sheets look a lot uglier. And then, of course, sovereign debt. The US is the big kahuna here, but Europe, Japan, China, they're all up to their eyeballs too. This is the triple whammy. And what's really nuts? These aren't independent. When sovereigns wobble, they impact corporations and consumers. When consumers break, tax receipts vanish, feeding sovereign stress. It's a doom loop, and all of it, absolutely all of it, was predicated on interest rates staying artificially low forever, which was never realistic. You can see how fragile it is every time the Fed even flinches at raising rates. They tried that in 2018, and the markets puked. They tried again more aggressively post-2022, and we're watching the aftershocks now. Commercial real estate is rolling over. Office vacancies through the roof. Regional banks trembling because they made long-duration bets with short-duration deposits. It's a classic mismatch. And all of this because the system was built on a delusion that borrowing forever at 1% was sustainable. It's also why the T-bond market is the single most important tell right now. You can track stock market euphoria, you can watch Bitcoin fly around like a bottle rocket, but the long end of the treasury curve is the spine of the entire global financial system. If that breaks, and it's showing signs of stress we've never seen before, then everything else becomes rearranged overnight. Remember that failed rally we talked about? T-bonds rallying from 114 to 121 and then collapsing back to 111 in 2 days? That's the bond market screaming, "We don't believe the story anymore." It's actually terrifying because in past downturns, like the dot-com bust or the 2008 crash, treasuries were the safe haven. Investors flocked there. It drove yields down, gave the government more cheap ammo to bail out the system. What if next time they can't? What if next time people don't run to treasuries? Because they've finally figured out that the debt itself is the problem? And this is why I keep hammering the point that gold and silver aren't just speculation. They're monetary life rafts. It's not about getting rich quick. It's about opting out of the lunacy. Because when confidence in fiat collapses, you don't want to be holding a promise to be paid in more fiat. You want something real, something tangible. And frankly, that's also why the biggest, most sophisticated players in the world, the central banks, the sovereign funds, the ultra-wealthy families, are stacking gold and silver right now like it's going out of style. They see the same math we do. They've just got better seats at the table. People sometimes snark, "Well, gold doesn't pay dividends." Okay, genius, the dollar does. In real terms, the dollar is losing 8 to 10% a year minimum, depending on what you actually buy. CPI is a joke. Even if you believe the official numbers, your cash is bleeding. Gold doesn't yield, but it also doesn't default. It's nobody's liability. And in an environment where counterparty risk is metastasizing, that's precisely what makes it so valuable. And let's not forget silver. We're watching one of the most insane multi-decade technical setups ever. A 45-year cup and handle formation that is on the verge of blowing wide open. Every time it's gotten up near the mid-30s, it's gotten smacked back. But these repeated tests build energy. And now we're seeing silver close over $36, with Shanghai premiums pushing above $38, even $39. That's an arbitrage magnet. It means physical silver is getting vacuumed eastward, draining Western vaults. Once it decisively clears this resistance, there is almost nothing structurally in the charts to stop it until the 70s. And if you're into historical ratios, look at the gold to silver ratio. Over 50 years, it's averaged somewhere between 50 to 1 and 60 to 1. Right now, it's still in the low 80s. That's absurd. It's telling you silver is historically cheap versus gold. When that ratio normalizes, and it always does, silver will run twice as hard. Vince Lanci likes to call it the silver slingshot. When it finally gets released, you're going to see moves that will shock people. We could be talking triple-digit silver before this cycle is done. Meanwhile, the public still doesn't care. You walk into a bar and bring up gold or silver, people roll their eyes. They want to talk about meme stocks or their new crypto bag. The average person hasn't bought into the idea that the system itself is broken. That's exactly how bottoms look. You want to buy your insurance when it's cheap, when no one wants it, not when everyone's clamoring at the doors after the crash. And look, I get it. People want to be optimistic. They want to believe the Fed has everything under control. They want to believe the next election will fix it. They want to believe the magic AI stocks will grow us out of this mess. I'd love that too. But reality doesn't work on hope. It works on math. And mathematically, we are way past the point of no return. The debt service alone is becoming lethal. When the US was borrowing at near zero rates, nobody cared if we ran $2 trillion deficits. Now with rates at 4 to 5%, that math blows up. Debt service is already closing in on $1 trillion a year. Soon it will eclipse defense spending. Then Social Security. Then what? Do they raise taxes on an already struggling populace? Do they cut benefits and face riots? Or do they lean on the Fed to monetize even more? You know the answer. They'll print. They'll paper it over until the paper itself becomes suspect. And when that happens, we go from the slow grind of inflation to a sudden snap. That's how hyperinflations start. It's never a smooth curve. It's a confidence event. One day everyone believes the story, the next day they don't, and prices gap up overnight. Your dollars don't buy what they did yesterday. That's why you want to be long hard assets before the panic. I saw a great tweet recently from Santiago Capital. He said, the true power of gold isn't that it's stable, it's that everything else is unstable. That's profound. We keep measuring gold in dollars, but the reality is gold's value doesn't change. It's the measuring stick that's warping. An ounce of gold buys roughly the same amount of oil or wheat it did decades ago. It's the dollars that are getting devalued. The same with silver, only more volatile, more leverage to the monetary chaos. So where does this all go? I think eventually we end up in a multipolar world where the dollar is just one of several major settlement currencies and gold becomes the neutral bridge. The BRICS are already setting up systems for this, the Shanghai Gold Exchange, the vaults in Saudi Arabia and Hong Kong. This is all laying the groundwork for an alternative system where trade can bypass the dollar and settle in real assets. That's why the Chinese are encouraging their citizens to buy gold and silver. It's why they're draining COMEX and LBMA inventories. They're preparing for the next monetary regime. And let's not kid ourselves. The US knows it too. That's why you've seen record deliveries into COMEX, not just from Asian interests, but also quiet domestic hands. Somebody is building a defensive position. When you see $8.5 billion of gold taken out for delivery in May alone, with month after month of record drawdowns, that's not retail buyers. That's sophisticated capital taking metal off the table before the music stops. So yeah, we're in the end game of this fiat cycle. I think we'll look back in 10 years and this will seem obvious. Of course the debt blew up. Of course gold exploded. Of course silver ran wild. But right now it still feels surreal because the system has held together for so long. People have a recency bias. They think, well, we've always muddled through before, so we always will. That's not how history works. Empires always look indestructible until suddenly they're not. So my advice is simple. Ignore the day-to-day noise. Stack your gold. Stack your silver. Keep an eye on the bond market because that's your real trigger. And remember, this isn't about chasing tops. It's about surviving the transition and coming out the other side positioned to thrive. Because when fiat finally breaks, those holding hard assets won't just preserve wealth, they'll be in a position to buy the world for pennies. And look, if somehow I'm wrong, if the Fed becomes miraculously competent, if politicians find fiscal religion, if debt magically pays for itself, and we all ride into a unicorn sunset, well then, you've still got a chunk of real wealth in your hand. No harm done. But if I'm right, and frankly the math says I am, then you'll be one of the few people not staring at a brokerage account turned confetti, wondering what went wrong. So that's my message. Stay sane, stay skeptical, and stay grounded in something that isn't created by keystrokes. Because in the end, gold and silver are not investments. They're exits. They're your insurance from the inevitable arrogance of the people running this paper charade. And trust me, you'll sleep a lot better at night knowing you're protected.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.